Welcome to another episode. Today we're joined by Brian Mehler, the CEO of Stable. Brian, welcome to the show and thank you so much for your time.
Oh, my pleasure. Thanks for having me.
Awesome. Brian, why don't we start with like a quick background, like how did you get into crypto and what made you build Stable today?
Definitely. My journey in the crypto space started back in 2018. I was working in traditional finance at a private equity firm and was asked to join the team at a company called Block One. That's the developers of the EOS ecosystem. So was fortunate enough to join them as the first member of the EOSBC team. That was where we put $1 billion to work investing in the EOS ecosystem. And, been a part of that since 2018 and worked on a couple other ventures. And then most recently was invited to join the Stable team as one of the leaders to help get us to market and to grow. So it's been a fun journey over the past number of years.
Why are you so bullish on Stablechains? I mean, it's like 2025 was the first time we probably heard of Stablechains, but now it feels like where have they been all along, right? So what's your thesis and why did you decide to like work on this specific sector of the industry?
Yeah, I mean it's my daily life working in stablechains. I would say what it is that there's an advancement that's happening in the crypto space, and with that advancement, obviously payments is something that everyone does worldwide, regardless of the currency you're using. Everyone's involved in some sort of payments, and it was a natural progression to get onto the blockchain and to use crypto as a means of like moving value between users. And I would say like with the stable chain was that the other layer ones are really not fulfilling the needs or like the necessity that was there. Because when you're competing against traditional payment rails, not just like you can't be 10% better, you have to be magnitudes better than what currently exists. So I think that's what kind of led to the rise of stable chains. And obviously, the past few years, there's been a big interest in stable coins in general, which gives better financial exposure to different geographics locations. So it's a natural progression, I'd say. I think the needs of the market are being fulfilled by the development of these type of stable chains.
I mean, so let's talk about the need of the market, right? As a user, like I've been using Polygon, Ethereum, and sometimes Tron, like when that's the demand of like the merchant. So in a way, the users' needs are still being met. Uh, the gas fees is also pretty low. Maybe it's because of the bear market. So when you talk about the need of the market, are you talking about today's users, or are you talking about like merchants at scale or like institutions?
I think it's a mix. I would say, one of the frustrations out there, you have the other layer ones that are out there. They weren't built for payments. So while it does serve the need, it's not necessarily like as fluid or as frictionless as it should be. And as you mentioned, like gas fees can be low, but at the same time, they can be substantial. And it depends like what type of volume you're doing. While some individuals may not feel too muffed by having a small gas fee, others that's actually a really large amount of like the money they're moving. It's just different perspectives from different people. So I would say, trying to build a system that is easier to understand, and also doesn't present that same catch 22. So yeah, in a traditional sense, when someone's not crypto native or you're trying to send money to someone who's never used a stablecoin before, I think the really confusing part sometimes, and it's an onboarding and it's a learning curve, but having to send someone, let's say USDT, the largest stablecoin out there, you send that to someone's new wallet that you help them set up, whether it's like over WhatsApp or like on a phone call, you kind of walk them through the downloading of like a non-custodial wallet or something, and they get that up pretty quickly. And then you have to explain to them, well, now you need to either buy ETH or I need to send you ETH. So then that's more complication. I would say if you're looking at a traditional bank, when you want to send someone money, whether you use, a system like Wise or like a bank transfer or Western Union, you don't have to send that second round of currency. And I think that's where stablecoins, we're having a little bit of an onboarding gap. And I think that's where like stablecoin chains built for stablecoins is really able to kind of like jump that hurdle or close that gap a little bit.
I mean, so let's talk about a specific example, right? Like maybe let's talk about the OTC desk experience. Like if you're using Tron, for example. So like you mentioned, one, you have to know what Tron is and you have to download like Trust Wallet because that's the only thing that's working there. Then you have to move funds from Solana, Ethereum, like wherever you have them. And you also have to have TRX, the gas token on that chain, right? So there are
Yep.
5 or 6 pieces, even for a crypto native users, that they have to figure out, and maybe they're using for the first time, right? So,
Yep.
so you're right in saying that there are so many hurdles there. What do you do differently that will change for like the average user with Stable?
Yeah, I mean, I think that's what the stable team, when they came together, and what we launched last week with launching the mainnet and upcoming with some of our mobile apps that are rolling out, is removing all that friction. I think like
Mhm.
kind of one of the points that I know, like being in the space for a long time and watching a number of individuals like firsthand kind of introduce them to crypto or setting up people's first wallets for them, is it always feels like a little bit of a gamble. And I think that it's like a weird part of using money. I think money should be like safe and secure and at your fingertips, not something that you feel like you're risking. So as you mentioned, you have to download certain wallets and have certain tokens and bridge and swap tokens. That's kind of scary, and like you feel like you could
Mhm.
lose something at any point in time. So I think the individuals that may not be onboarded onto crypto may feel more comfortable staying in the banks that they know and they like, even if the fees are high, and even if they can't bank 24 hours a day, 7 days a week, they still feel a little bit of security. And I think that kind of goes back to the adage of people like putting money under the mattress because it's safe and secure. You know where it is, you can get it when you need it. And that's what we want crypto to evolve in terms of like using stable coins. And I think what at Stable we're doing with the stable chain and our mobile apps that are rolling out is in early next year, we're going to have something called Stable Pay. And what that is, it's a non-custodial wallet. It's easy to use. It's set up in an interface that people are familiar with. And what you're able to do with that is like if you're sent USDT to that wallet, all the complications of using crypto are abstracted away. It's pushed down a layer. It's user friendly. You don't have to store different keys and memorize different things and
Mhm.
worry that you're going to lose access to your money. We make it safe and secure, and it how it should be, like a native user-centric app. And that's what we're really putting. If we're putting users first, but we're also putting developers first, and we're also putting institutions first. We really are focusing on like the three pillars of like our adoption model. And I would say, having that mobile app, you can get sent USDT, and our native gas token is USDT, and so you can send and receive within a matter of seconds. And I think when you mentioned earlier about layer ones and the difference with our chain is that the finality is sub-second. So the difference is when some of the other chains you may use, and let's say the fees are good or bad, depending on the day or the network congestion, you'll have that money sent to you, but you're waiting for it to be final, and you can't move it until it's final. And that's a weird thing because sometimes you need to move money a little quickly. Someone's sending you something, you got to pay that right back out. When there's a 15-minute gap for you to receive it, and then you send it back out, and it's another 15-minute gap, that slows things down and you're not really getting the advantage of using something like a traditional payment system like Wise, where you can get the money in a matter of minutes, but you're paying a higher fee for it. Sometimes people pay for that convenience, and we're trying to level the playing field across having like low transaction costs, but also fast transactions.
So, would you say the Stable Pay app, like that's your main go-to market push? Because it feels like, I mean, when we talk about chains, there's a very different mental model, right? Like maybe it's because of how we've grown to use chains. Like whenever anybody says there's a chain, you start thinking about the different apps that are on that chain, right? But with stable chains, like I feel like the mental model is totally different, where the app is the main thing that we're talking about, and the chain is just like literally the infrastructure there to enforce payments and like all of those use cases at the best like speeds, settlements, and all the features that are required for that specific use case. So I mean, I think my question is like, how are you thinking about stable pay as the app to onboard new users?
Definitely. I would say Stable Pay, the mobile app we're launching, is one of three pillars of I would say of our focus. That's our consumer side. That's really getting consumers onboarded using USDT or other stable coins seamlessly, easy, and cost effectively. But then on the other end of the spectrum, we're also focusing on the institutional side. So now, velocity of money for banks or for financial institutions, they're able to send and receive and get that finality to move that money more times an hour, and we're providing that there. So we have the proper tools and the safety features and the audits and everything that's needed to make sure that those financial institutions are comfortable with the large sums of money that need to be moved, throughout the network. And then in the middle, we're obviously focusing on the developer side. So we focus heavily on making sure that the SDKs and the software works in a manner where people are familiar. So we kept our chain EVM compatible. So if, products are already built for other services or other chains, in the EVM ecosystem, they're able to actually just port that over and use it natively with our chain. So I think that's kind of like our go-to-market strategy, is focusing on those three areas, because we know if we can get those three areas to embrace the chain and start using it, we can see the high uptick and like the growth of the network. And I would say also we have some other products coming out, maybe more geared towards the institutional side, things like a guaranteed block space, where that's where we're
Mhm.
focusing on building a specialized payment rail for high speed transactions for those institutions where they're able to predict their cost and also their time. And those are things that are not available on a traditional layer one. So from like a CFO's perspective, they need to figure out what the cost is for moving, let's say, you know, tens of millions of dollars a day back and forth for, different reasons. They now know what that's going to be denominated in the same currency they're paying, just like they would with bank fees. So I think that's kind of our go-to-market strategy. We're looking across the board rather than the single sector. StablePay is definitely our consumer focus, which is for people who are currently using blockchain to move stablecoins or are using cryptocurrency, but it's also people who may not be crypto native. We want to make sure that the experience is like seamless and effortless. So we definitely feel that anyone, whether you're crypto native or not, is going to enjoy that app. So that's kind of
Mhm.
our go-to-market strategy.
Okay, makes sense. I mean, for the financial institutions, like you can obviously you have to reach out to them and like you have to talk to the right person at the right teams to explain the vision, right? So I know what's the way to like get distribution there, but for the average user that's not in crypto today, like how do you actually get to them? Because that's one of the biggest questions, right? Like I feel like everybody is building a new bank, everybody is building an app for users outside crypto, but from a marketing perspective, nobody actually knows how to get outside the crypto Twitter bubble. And that's a question for myself as well. I'm curious, like if you guys have any new ideas.
Yeah. Look, it's a full effort of our team. So we have a great business development team spread across the world. And the focus there is a lot of them have experience in the, you would say, traditional finance, myself included, having worked in the financial institution for the past 20 years. And what we're able to do is, tap into our networks. Whether it's our personal networks we've had developed over our working career, or we're fortunate enough to be a part of some great institutions already, and we get that network effect. So I would say, kind of looking at our cap table and announcements we made in the past, we have PayPal Ventures as an investor. So there's a great network of partners that they have there that we get to work with, and such as like bringing PYUSD onto the stable chain. In addition, we also have a great partnership as an investor from Franklin Templeton. So that's a very traditional financial player that's been around for years and years, and they're looking to embrace different cryptocurrency. They build in house. They have a token called Benji, and we're looking at novel ways of expanding the exposure to Benji across our chain, and work to see how far we can take this new mandate, because we firmly believe that the financial institutions appreciate the technology behind stablecoins and crypto, and they want to deploy it and use it because it's faster, it's safer, it's more secure. And so they're looking for the ways that they can do that implementation, and we're here to be that partner. So it's a lot of outreach, but at the same time, we get a good number of like inbounds from our side where people have seen our press, whether it's through our investors or through some of the sponsorships we did at Korean Blockchain Week, and they then reach out to us, and they're looking at the space and they have a very keen interest. And so that's really it's a mix of both in and outbound.
Makes sense. I mean, I'm thinking of it as like a Venn diagram almost, where there are two circles, crypto curious and like crypto native, and then they sort of have to come together, and that middle circle has to increase in size.
Yep. Yeah.
um, yeah. Okay. So what do you think about Tron? Like, because I feel like Tron is a curious case, especially for payments, right? Like, it's not a chain built for payments. It's a general purpose chain, but it doesn't have like apps that we think of when we think of like Ethereum. But when you talk about any like merchant, any exchanges, any like OTC desks, they're all supporting Tron, right? So that is the dominant stable chain or payment chain today. So what do you think of Tron as a case study? And like, do you have any takeaways from how they've gone about their journey?
Yeah, I would say, look, people want a great product. People want something that is consistent in the use, and they obviously, I think everyone in the world, regardless of the service you're using, you're pretty adverse to like increases in cost or surprise fees. And I think, when individuals are looking at which chain they're going to move a lot of money many times a day, that they're going to look at the chain that provides the best value in terms of like a combination of like what they sacrifice in speed for what they save in expenses and vice versa. So I think like any layer one that was available at scale, that was proven secure, had been around, and had the cachet behind it, that they would naturally gravitate towards there where the fees were the best for them, where they didn't have to worry about as much congestion or as high a fees. So I think that's the natural direction that stablecoins turned. And I think that's the positioning or the market opportunity that Stable has when building the stable chain, is that we know that we can keep the speed consistent and keep the fees predictable and easy to use. So we don't have the volatility of a native gas token that, changes with market perceptions. So if they're buying, instead of having to buy gas and like the value goes down later on because you're holding some other currency and having the balance books there, they're able to have a much simpler approach to using crypto. So we think that the natural progression from existing layer ones will be, pretty seamless. People see, hey, this provides the same service, but it's better and faster and less expensive. It's kind of a no-brainer. I think it's kind of like if you can take different modes of transportation, but you're going to take the one when you're looking at flights online, they all go to the same place, but you really have to figure out like, is the cost difference between two airlines, is it worth the difference? If the price is 50% more on one, you kind of start weighing your options like, well, what do I get at this airline versus the other one for 50%? Usually people are conscious and they will go for that lower price as long as the service is guaranteed and it's the same experience.
That makes sense from like a very rational business outlook, right? But if you think about it, Tron's adoption, I don't think is a planned thing, right? Like it's one of those that just happened because of
Mhm.
the right time, right tools being in the hands of the right people. Like it almost happened with the adoption of USDT, right? So if you think about, let's say, adoption of USDT in Africa, it's not because it's the best stablecoin. It is like, but that's a separate discussion. But it's because it was the only stablecoin, right? So they just don't see a reason to like switch stablecoin providers. So I think there would be a large part of the cohort that would have the same logic for stable chains as well. Basically, the logic like don't fix what's not broken in a way.
Yep. I totally hear you on that. It's obviously, we do a lot of listening with potential clients and people who are larger in the market. We want to hear what their pain points are. So when you have someone in a larger financial institution who needs to move high volumes of money at a high rate, they're very cost centric because they need to, their margins are going to come to play. So when they're weighing their options, if they start moving over and their payments then for the end user, so it's B to B to C, let's say, then the tokens will be on the stable chain or another stable chain, and their end users will then take that disbursement on that chain. So I think it may be a bottom up approach and also a top down approach. I think
Mhm.
cost and time are big. So if you need to send the money and one option is a 30-minute wait because you have to spend 15 minutes waiting for it to settle and then 15 minutes when you send it out, that's a lot of time, and it kind of becomes hard to justify a more expensive, slower product over time. You may do it once or twice, but the more you see, the more you hear someone else doing it. Just like you talked about um, the migration onto other layer ones from, let's say, the original of Ethereum for like where USDT was is heavily there. I think it's just a natural progression that happens over time.
Mhm. What's the most important domino that you're looking at? Like, what's the first one that needs to fall that sets this into motion?
Sure. I think we tackled a lot of that early on. So we understood that there needed to be a certain amount of liquidity on chain. And so we had a really great experience doing our pre-deposit campaign in two phases. So from
Mm.
there was over $2 billion in pre-deposit commits. We kept, and the vaults that we had were allowed for 1.32 billion. And so that was a really good indicator that people trusted the product, trusted our team, and were able to roll that out. And so right now the vaults are opening up and people taking the withdrawals. But that put a lot of USDT on chain, on stable chain, following our launch. And so like I think that's kind of like the momentum we needed to show is that like here's a large number of people, tens of thousands of people who believed in this product, understood it and supported us, even before launch. So we're going to keep that momentum going. And I think that's like that first domino you were talking about. And then from there, it's the market adoption and some institutional players to come into the fold.
And does the bear market change any of your plans? Because like liquidity is much easier to get in a bull market, but bear markets are totally different.
Yeah, look, I think markets are part of everyday life, whether the markets are a bear or bull, you always have to make sure that you're like planning for the future. But at the same time, money doesn't stop flowing. I think that's kind of like the premise that we focus on is that while it may not be, the liquidity cycle of a extreme, exciting market, now you say it's a winter time in some parts of the world and it may be quieter on the crypto chain. People are still moving money. It's not that that hasn't
Mhm.
changed. So I'd say again, with ours, people didn't lose money holding a native gas token that lost a percentage of value because ours is just denominated in USDT. So I'd say there's less volatility there, that people are being more excited for, more willing to give it a shot because if it's still delivering the same product and they don't have to eat the FX risk, I find it very hard for someone to say, no, I want to have a more expensive product.
Makes sense. And is that is your argument the same for stable chains against like the TradFi rails, like let's say Swift versus ACH? Like it's just a better product. Crypto is a better product. So eventually, over time, institutions and users will move towards crypto rails.
Yeah, and I would say it's not just like my perspective. I think you know, every day you read the news and you get updates from whether you know, yesterday Visa adopting stablecoins for certain settlements. As we mentioned, like PayPal has the PYUSD. I think that market's growing, and so it's not necessarily just my perspective or people who are into stablecoins are, you know, thinking that this is happening. I think that the traditional payment rails, because there's fees at every single step, whether it's the credit card side or the ACH or the Swift, it's not an advanced product. And it's not me saying this, you know, Swift from 1973, you know, started, it hasn't really advanced. It's a great messaging system. Like what it does at its core is good. It's not fast. And that's the problem. So if you need to move money from A to B, it shouldn't take days. So, you know, we're used to the speed of the internet. You have things like AI that are constantly advancing, new models coming out from all the major players on a regular basis, but money isn't keeping up with that speed. So our focus for the stable chain is getting money to move at the speed of the internet because that's how everything else is operating. So it's kind of a misalignment of incentives for different players. The traditional rails, people want to hold on to that market share and don't want to change because they know that they're going to get left out. So we're here to present that new opportunity. And a lot of the players that are currently using those rails don't see the value in paying the higher fees because I think you look at a bank and people try to, you know, put banks in a bad light. I don't necessarily do that. The fees that they're charging, whether it's for credit cards or for transfers, isn't necessarily their decision. The networks they're using have fees. And when those fees rise, or increase, they have to pass those on to the end users. But at the same time, you blame whoever telling you what that fee is, even if they try to break it up, where they show you like network fee or, you know, transfer fee, or they try to break it up so you understand it's not just them. They're getting hit with the fees as well, but they just have to pass them on. But if they have an opportunity that's much easier, seamless, and safer, you know, I think we're going to see that growth continue to show the adoption rate.
Hmm. And we can't imagine a Swift and ACS to go down without a fight, right? So, what do you think is going to be their plan when these things like they seem obvious to us, and like you're talking, the banks are also starting to notice the financial institutions. They see that there's just higher fee on the one side, and then there's like internet native speed on the other side. So, what do you think would be the natural response of a Swift or ACH looking at this crypto boom, and especially after the regulations are getting a lot better in the US, right? Like now they will actually feel the heat in a way.
Yep. I think the change that's happening is going to be where do the incentives align, as I mentioned. Whether it's Swift or ACH or Fedwire in the US, what's going to happen there is that if it's still consolidated in a manner that the fees are not benefiting the end user, it's going to be benefiting, like, let's say that inner network or the multiple steps or the hops that the money has to go through. It's going to be very hard for them to relinquish those fees because that's their operating budget. That's how they stay in existence all these years. So it's very hard for them to pivot to, let's say, using a stable coin or stable rails, you know, or a payment system built on blockchain and still charge those same fees. So it's hard for them to pivot, embracing a new technology and keeping the same fees because now it's going to be a market. You know, the markets will set the cost because if they're right now the only player in the market for Swift, like that's the unit you have to use. There's IBAN and Swift for international transfers. And when you're moving that money, there's no third alternative. Now that we're presenting a third alternative, they copy that alternative. The fees have to match. They can't charge the same $100 per transaction for an international transfer when it's clear that if they're using a stable coin or a stable rail that they build for themselves, knowing that the general purpose, the specific purpose built stable coin rail, like let's say stable, that's charging fractions of cents. It's going to be very hard for them to justify that $100 fee that's getting passed on the consumer when there's an alternative that is, you know, a billionth of the value of cost.
And do you still see that as a win? Like let's say if Swift adopts stablecoin rails, Do you still see that as a win for crypto? Because I bring up this question because like I was reading up about neobanks and like crypto credit cards, right? And a lot of people were talking about how crypto credit cards are cool, but at the end of the day, they're bringing more value in their current form to Visa and Mastercard, right? Because at the end of the day, that's where all of the payments are flowing through. So there was a question about like, is this net beneficial to crypto or not? Like, I'm curious, how do you think about that? If Swift, ACH, all of these incumbents adopt crypto rails, should we see that as a win for the ecosystem?
I would say the adoption that we're discussing in this idea is beneficial because it would give the regulation or give the coverage necessary for other adoptions of crypto and blockchain based technologies or stablecoins to grow. So I would say like as those regulations come into play, there's going to be more of a larger market. So I would say for my viewpoint of it, like that's why we're focusing on building the stable chain and building the new rails for payments in the future is that we're going from the inside out. While you're
Mhm.
talking about the stable coin credit cards and how that affects the credit card market, we're looking at the much lower level, deeper down, the insides of the ecosystem. Because while you can build the front end or the user experience very easier, that's more of like a marketing and a deployment of those resources. The deep down layer, that's the infrastructure. Infrastructure is not as fun, not as exciting, but it really takes like a lot of hard work to get it done. So all infrastructure, whether it's physical or technology based, you have to get that in order, and then you can start building things, the network from the inside out. So while there are some activities that you mentioned for credit cards on like I would say like the last mile or the end user experience, there's still the whole middle and the beginning that needs to be tackled.
Hmm. Makes sense. Um, a question about stable chains. Like we all know the bull case for stable chains. Like at some point, all the payments flow through these chains. But what's an argument that you've heard against stable chains, and why do you think
Right.
that's wrong?
It's a good question, putting me on the spot. I got to battle against myself. I would say why so many or like why are there multiple or why isn't there just one? And I think it's a valid question. It's like, well, why do we have many of them? And I would say it's the same thing of any selection out there. The market's going to dictate whether there's consolidation, whether there's room for new entrants. And I think right now we're like in the adoption curve, we're at that very beginning. And so this is where multiple players should enter the market. They should test the waters, see what people like. And I would say they're all different to a degree where they're focusing on different parts of it, whether it's like how their tech suite is being built or what the product is. Is there a token? Is there not a token? So I'd say right now this is the exploratory phase of proven products. So the software works, the technology is based, the need for stable coins is there. So all those aspects are there. Now it's trying to figure out the product market fit of the stable chains. So while there's many right now, there's definitely going to become more to the market in the near future. Which ones survive is going to be based on like how do they service the customer, how do their go-to-market strategy work, and like what's the adoption like. So I would say it's going to be it's part of it. So there will be many chains right now.
I mean, I think that's fairly straightforward, right? Like anything that's new, there have to be a lot of players, a lot of experimentation, and then with time, as markets mature, like you will just see the winners come out on top, right? So I think stable chains will also have a similar market structure. But what do you think about stable coins? Because stable coins are not new, and in a way, USDC, USDT obviously dominate. But now we're seeing so many more stable coins, right? And I don't think the same argument would suffice for the stable coin market because it's one of the oldest markets in crypto. So, do we need so many stable coins?
Again, I think it's a little bit of that product market fit. Also, it needs to be a global aspect because money is, while infrastructure can be universal or be adapted for universality a lot easier than the currency, I think the end currency, which is kind of what people are holding the value in, will be definitely focused on like the individual markets. And I think with the stable coins, as you mentioned, like USDT, USDC, also PYUSD, I think what they're focusing on is the usability. So people already know and use PayPal, the mobile apps across the world. And so that's a way for them to have a better transaction experience for users moving money across borders because there was already a need for it. So they noticed people in the US were using PayPal, but also PayPal is very big in Australia, and they needed to move that money there, but there was FX fees and time and delay. Now they're able to solve that by using PYUSD and move that a little faster, easier for lower expense. And I would say as regulations adopt, whether they change the regulations or improve or, depends on the jurisdiction, but if you're able to have a more beneficial product for the end user for holding stable coins, there's a myriad of different things that can be done for that, whether it's like yield or any of those other DeFi products that are native to the token. I think that's going to be interesting to see that fold out. But at the same time, I think for the general market is that people want to manage that money differently. And so we see obviously a leader like USDT from Tether is definitely holding that lion's share of the market, over 70%. I don't see that shifting, anytime near soon. But rather, what I would see is that there'll be new entrants that are custom built. So, like the Tether's USAT, that's really focused on that U.S. market to meet the guidelines and the framework that's set through the Genius Act. And I think that's the adoption you'll see there. So I think there'll be a little fragmentation that happens to make sure that the local regulations are met. But then hopefully what happens, they become transferable based on the dollar amount that it's indistinguishable what you're using.
Hmm. But from like a company perspective, do you foresee that every company has their own stablecoin? Like let's say an Amazon having its own stablecoin, Netflix with their own stablecoin. In a way, I think it almost looks like a points program system, right? Like where every dollar in the system, like earlier it used to be a point, it can just be the company's stablecoin at some point. You just retain more value that way.
I totally understand what you're saying. I know Coinbase earlier today announced that people can mint their own stable coins to their infrastructure, and I think that's definitely going to be a growing market right now. I think that's a lot of like, the exploration that needs to happen there, where the pools of liquidity are deep enough for these companies because you look at the companies, they're holding these large cash balances, and let's say they can't put them to work, or the money's locked up, or they can't speed things up in terms of like adoption or integration of different expenses across borders. I think that's where there will be value. But to say that every company has a stable coin in the future, I'm not quite sure. It's a lot of cash management. It's a lot of asset management in order to really use those stable coins at scale and have the liquidity and get into the market. We know the needs and the time and the energy it took to launch for layer one and to get the stable token that we have, our governance token out of the market. Like that's a lot of work. And
Mhm.
so there's a lot of energy that needs to be done in the ecosystems. But if you have it where the tokens are transferable and it's really the balance sheet of that company, right, as we said, like it's financially advantageous for those companies to have those stable coins because they can put their treasury to basically to work, getting the
Mhm.
yield and they get a hold of themselves. But time will tell how that plays out in the future.
I think it'll be pretty interesting. Like because this market is so hot right now, I do think a lot of infrastructure providers will also come up. Like Coinbase has that service now, so they will continue to make it easier for companies to launch stablecoins. And I think at one point, like every company will just be like, okay, why not? Like it's just an additional 3-4% on billions of dollars in the treasury, right? So it's just added money for the stakeholders, for the companies. So at one point, the advantages will just outweigh the work, which is like going down anyway.
Yep. And that's the thing. It's um, if your main business of your company is selling widgets, you're not in the financial management business. So it's not really worth that extra 3%. You should really focus on the core business. But at the same time, there's other companies that have people call Starbucks, for example, their Starbucks card is actually bigger than most banks. Like the amount of money that they're holding in liabilities, and deposits from people with the cards, that's a lot of money that's not being put to work. They have to hold it. It's got to be available. It's got to be liquid, and they have to be able to like book that revenue based on when people swipe their Starbucks card. But for them, like that's a great business model for them to like make that extra yield on that percentage or make it more accessible or transferable. And instead of people like losing cards or cards getting hacked, they can have something a little safe and secure that's really denominating the dollars that people are depositing and have that be a Starbucks dollar, let's say.
Mhm. Yeah, I mean that'd be interesting. I would love to pay for my coffee with the Starbucks stablecoin.
Exactly.
But so why did you guys decide to take such an opinionated approach with USDT as a gas token? Like stablechain is an ecosystem for all stablecoins, right? But then at the end
Right.
of the day, you did decide to like go with a specific asset as gas token. So why was that USDT?
Yeah. Putting together this company, the team that came together really was supported by a number of individuals. Paulo from Tether was a great supporter. He's still he's an advisor to the business. And so, there's investment from Bitfinex. So, the leaders of the space really came together in not just building stable from the inside out, but also from the outside in. And so, looking at the market, 70%, that means that you have a USDT would be available to anyone if they need to pay for that gas. So instead of trying to explain a specialized token or a token
Hmm.
that's hard to get, it was just easy and accessible. And we know that it has the liquidity and the depth that's necessary to make sure that it's available worldwide and easy to use.
And I mean, it, isn't that an opportunity to kind of differentiate from competitors? Like, because I feel like a lot of chains would either go for USDT or USDC. Like, even Circle has their own chain at this point. I think Arc will definitely have USDC. Plasma has USDT. So, in a way, everyone will kind of come to this conclusion that let's just use USDC or USDT.
I think that will be a natural convergence. And I would say, obviously there's a difference between USDC, USDT, but I'd say like some of the other players that may denominate their gas fee in USDT, if the getting a little bit more into the weeds of technology, if you read through their docs, it's really a settlement with their native token. So it's still, a transfer or conversion that's taking place. Ours is full, like locked into the core of the chain is USDT. So I think that's a differentiator that we have. So while they may denominate the gas fees in USDT or another stable coin, the actual transaction and settlement may be different. So I think as the chains kind of develop and evolve, I think that's going to be a large differentiator that we'll kind of see in the market.
Okay. Awesome. I think that's about it for my questions on stable chains. I want to know, like, what metric are you tracking internally to see if what you're doing is working?
Definitely. There's a number. So, it's been a week since launch, and so it's a lot of onboarding. We built it, people are coming, and obviously it's not a overnight, everything's to the brim filled. We see that natural growth and progression because we want to make sure that we're providing the services, everything's operating. We ran a large test net with our day one partners, and so we're continuing that momentum. Things are operating, but it's obviously the wallets, transactions, total lock value. So we are seeing those metrics grow day after day, and we want to keep that momentum up and grow. So we have in our side, we have a certain rubric that we're using to
Hmm.
base that growth on. And we know there's a couple I would say like large unlocks that we have with some financial partners that are coming into play as they move over volume, but they also weren't going to move over day one. It was going to be like they need to start testing the waters with the live network and seeing that grow. So it's a progression. And obviously we launched in December, so the holidays are coming up and certain markets are closed. So this we felt it was the perfect time to launch because we launched, early December, everything's still going, but we get to have that quiet time right now, leading into like next week and through the new year, where that's where in January those unlocks from those financial partners will start coming into play. But yeah, I think you see our announcements, what in the DeFi space and our partners who are coming on board and announcing. I think that's kind of an indication of like what's to come in the very near future.
Okay. Early on, you mentioned how like locked capital is also an important metric for you because like that shows that the market is trusting the chain, right? But how would you track the money velocity? Because I would reckon for a payment chain, that's an important metric, right? But I don't. Is there a metric that actually is trackable?
So, I mean, the in a simple sense, no, it's not a single dashboard you can go look at it. It's you have to extrapolate the data out a little bit where, you'd follow certain wallets, certain contracts and understand like how many transactions they're doing based on the dollar amount and understand that how much money went in and out of the wallet in a single day. So it's a little bit more of a data analyst approach rather than a simple screenshot. So it's not a click of a button and it's there. There's a little bit of mapping that has to take place to kind of figure that metric out.
And do you think that's more important for stable chains than like a general purpose chain?
Definitely. I would say the general purpose chains, what they look at is definitely going to be a very different bucket of metrics and data than we are going to look at for the growth and the health of the stable chain. I would say you don't need to have endless amounts of liquidity or depth of deposits on a stable chain if the velocity is really high because it's moving back and forth so quickly. So I think that was kind of a misperception that people look at stablecoin, stable based chains that they need to have, endless billions of dollars of liquidity. But in reality, if the money's moving quickly enough and there's ins and outs, you don't need to have endless amounts because then the money becomes stagnant. We want the money moving, flowing, and if it's not flowing, if it's sitting still, we want it earning yield, we want it earning a product. through our DeFi partners. So there's definitely more of a liveliness factor that we're looking for on our chain.
Hmm. Makes sense. And last question. What's the non-obvious bet that you're making today, and something that a lot of people would disagree with?
Oh, um, no. Um, I would say people have like some questions regarding like the need for, as we mentioned earlier, like the need for a stable chain or why another stable chain. And then
Right.
also, we get a lot of questions about like why or what was our rationale by really focusing on USDT. And we're really betting on the large market player. And I think that instead of like, because we were questioning, like, why didn't you launch your own stable coin? And that was us. We want to be that infrastructure layer. We don't want to be a complication. We don't want to be another stablecoin competing in the market. We want to be the best at what we're doing, which is the infrastructure for payment. So I think that was a question we got a lot: is why didn't you just use your own stablecoin as your gas token? Why not you instead of using USDT? And we felt, you know what? Let's use the largest player out there who supports us in this endeavor, who has the network, who has the experience in running this large stablecoin as our gas token, rather than putting ourselves in the mix. So we want to definitely be that underlayer, just like when you use ACH and Swift, you don't know all the steps, or you use a Visa and MasterCard. We want to be that layer that you don't even know it's there. You just are happy with the service and you really enjoy the experience. So I think that's kind of the question we get, or doubts on our bets that we've made, is that we don't want to be that over front and center. We want to be behind the scenes and powering the ecosystem.
Makes sense. I think Stable was one of the best launches of this year. So congrats on the launch.
Thank you.
And hopefully in the coming years, like we can see adoption numbers that resonate with this bet, right? And kind of back all of your logic. So all the best for that. And thanks a lot for your time today.
Of course. Thank you so much for having me. I appreciate it.
Lovely.
Thank you.